Okay, welcome to today's class, the Accounting and Finance Coaching session. My name is Echela Okori, and today I want us to look at something different from what we've been doing. I mean, we've done a series of classes, so let's test ourselves, especially if you're a beginner, if you're new in accounting. I want us to test the multi-choice financial accounting questions of ICAN. That's the Institute of Chartered Accountants of Nigeria, which I'm proudly a member of. So we're going to look at the 2024 diet exam, and we're going to look at multiple choice financial accounting questions. Incidentally, it is only at this level that you have the multiple choice financial accounting questions. So the questions are actually very tricky. So you have to be fast, but you have to reason, you have to compare. Basically, for multiple choice financial accounting questions, or for all multiple choice questions, it is not saying that some of the questions are not correct. Some of the options are correct, but there are those that are more correct than all of them, and that's the one you choose. So if you're ready, I am. Financial accounting questions, and we're looking at them right away. In the process of drawing up financial statements, adjustments are made for prepaid expenses and accrued expenses in order to comply with which fundamental accounting concept? What does it comply with? Is it matching? Is it prudence? Is it aggregation? Is it accrual? Is it consistency? If you have not watched our videos talking about accounting concepts and principles, please go back and watch them. The Accounting and Finance Coach on YouTube. And I want to appeal to you, please, to subscribe to this channel, share this information with your friends and your circle so we can increase financial literacy in our society. There are two terms here that the examiner is testing. The first one is prepaid expenses. What do we mean by prepaid expenses? Prepaid expenses are expenses that you have paid ahead but not yet enjoyed. You have not enjoyed the service, but you have already paid for them. For example, rent. Some greedy landlords charge as much as 2 years. They want you to pay ahead for 2 years. I mean, you've not enjoyed the facility, but they want you to pay ahead for 2 years. So that is essentially what a prepayment is. So for a prepaid expense, it is not inside that reporting period. It is only an asset. It is a current asset for you. That makes it an asset because you have paid for it and you have not enjoyed. You can demand for your money and they'll give it back to you. So it's an asset. You have to make adjustment to remove it. It is likely to fall into a different reporting period. So adjustment must be made for it. The second one is accrued expenses. For accrued expenses, you have enjoyed the service, but you have not yet paid. You are owing, so that is a liability. Now, this accrued expense has to fall into a period, so you have to make adjustment for it. Okay? It is possible that it is now that you are paying for it in this reporting period, but maybe you accrued that expense in a different accounting period, so you have to make the necessary adjustment for accrued expenses. So you make adjustment for these two items, prepaid expense and accrued expenses. Now, when you do these two adjustments, what are you complying with? You are complying with the matching concept. You are complying with the matching concept. And the matching concept is saying that for every revenue generated in a reporting period, you have to match it with the expense that was incurred to generate it. That is what it is. So we don't need to waste time with this. Let's move immediately to question 2. Question 2 says, a business proprietor failed to maintain proper records, but you managed to ascertain that his opening capital, closing capital, and drawings during the year were 225, 260,000, and 10,000 respectively. Determine the profit for the period. Now, this is easy peasy, but you have to look at it. There are two things that will make the capital, the beginning capital, to increase or to decrease. It will decrease if you made a loss, and it will increase if you made profit. So retained profit will bring about an increase in the opening capital. It will change it. So for you to move from the opening capital of 225,000 to 260,000, it means that you made a profit. The other thing is maybe there was an injection of capital by the shareholders. But in this question, we are not told that the shareholders put in additional capital. So there was no injection of fresh capital. So it means the only difference is profit. Profit is responsible for the increase from 225 to 260. Now, we are also told that there is a drawing of 10,000. This 10,000 is significant because a drawing is not part of the business. A drawing means you took out money for personal use. When you take out money for personal use, it is not permitted. So it is called a drawing. Okay? And that complies with the concept of economic entity. So you have to look at the person, the owner of the business is separate from the entity. So that's the entity concept. Now, what do? It means our closing capital, where do I write? Let me say our closing capital is 270. That is, I'm adding 10,000 naira to 260 to get 270. Then we'll now say less the opening. The opening is 225. This should give us, so we'll say 270 minus 225. This will give us 45. So our answer is 45. That is 45. 45K. Abi? So this is the answer. So the answer is 45,000. Let's move to question 3 fast. For multiple choice question, you have to be fast, really. But because I'm explaining, that's why I'm slow. Now, which of the following statement correctly differentiates bad debt from doubtful debt? This is simple, but you have to reason. You'll be surprised that most of the questions look like they are correct, but only one is the one that best answers it. So which of the following statements correctly differentiates bad debt from doubtful debt? Bad debt arises, A says bad debt arises when a customer is in difficulty, but might be able to recover from it. While doubtful debt is an amount. This is not correct. Next one, B. B says bad debt is an amount owed by a customer that the business believes it will never be able to collect. Yes, that's bad debt. Once the business believes that it will never be able to collect bad debt, it writes it off. So that's bad debt. This part of the statement is correct. I don't know whether the other part is also correct. While doubtful debt is an amount owed by a customer that the business hopes to collect despite the customer's difficulty. I think this will be the answer, but let's go and see other ones. C says bad debt is an amount owed by a customer that the business believes it might be able to collect. No, you don't believe you might be able to collect bad debt, so that is wrong. D, bad debt occurs when the customer disputes whether a contract has been fulfilled or not. No, not it. Bad debt refers to the dishonesty. No, so you can see that our correct answer is bad debt is an amount owed by a customer that the business believes it will never be able to be. So this is the answer. Okay, so that is question 3. And bad debt is an amount owed by a customer that the business believes it would never be able to collect. Yes, that's bad debt. While doubtful debt is an amount owed by a customer that the business hopes. You are hoping because the collection is in doubt. That's why you are hoping. But you hope that you'll be able to collect it, even though you know the customer is facing difficulties at the moment. So that's the correct answer, is that option. Let's go to the next one. Question 4 and 5. Question 4 and 5. It says use the information below to answer questions 4 and 5. A company has several motor cars that are accounted for as non-current assets. Okay. As at April 1, year 2, the cost of the cars was 300 and the accumulated depreciation was 160,000. During the month of April, the company bought a new car costing 77,500 and received a part exchange allowance of 20,000 against an old car. The old car originally cost 70,000 naira and its accumulated depreciation is 45,000 naira. It is usually good to start by reading the question before the answer. Let me give you that tip. It is very, very good to do that. So question 4 is saying, what is the carrying amount of the motor cars as at April 1, year 2? This requirement. Why it is better to read the requirement before the question is that after reading the requirement, you will still go back. You must go back to go and read the question. So why are you reading twice? To save your time, come and read the requirement. Read the requirement. This is a requirement here, and this is another requirement. So read the requirement before you go to the main body of the question. So question 4 says, what is the carrying amount of the motor car? Carrying amount is simply what? Carrying amount is historical costs less accumulated depreciation. Less accumulated depreciation. So this means what is the carrying amount of the motor cars? All the cars. For all the cars, we are told, so you go and get the historical cost of all the cars. A company has several motor cars, blah, blah, blah. The cost of the car was 300. So we have 300,000. And then accumulated depreciation was 160. So you have 160. 300 minus 160 is 140. So that is the carrying amount of the car. This one. That's option B. This is the correct one. Simple. Always remember that when they ask you for carrying amount is historical cost. So that's historical cost, the cost that you bought that asset, even if it is 500 years ago. If you are not happy with this, I want you to go back and watch my video on accounting principles, especially the one that has to do with historical cost principle or concept. Go and watch it so that you can be happy with this, so that you have a rock solid knowledge of why we're doing it that way. That is how accounting is. We make use of historical cost. That's historical cost or cost concept of accounting. So carrying amount is historical cost less accumulated depreciation. If you have amortization and impairment loss, you have to remove all of them. But in this case, we have only accumulated depreciation. So 300 less 160 will give us 140. Question 5. What is the gain or loss on disposal of the old car? Now, they say, what is the gain? So how do you know whether you made a gain or loss? You have to identify the carrying amount of the assets of the old car. When you know the carrying amount, the amount at which you disposed it, then you know whether you made a profit or that's whether you made a gain or a loss. So we are told that the old car, during the month already, the company bought a new car costing 77. No, that's not what we're looking at. We are told that the old car originally cost 70. Good, that's what we're looking for. So 70. The old car cost 70. And it had accumulated depreciation of 45. 45. So that means the carrying value 70 minus 40 is 30. That's 25. 25. So this is the carrying amount of the old car. This car, the carrying amount is 25. But how much did they sell it for? They received a part exchange allowance of 20,000. So you are looking at 20,000. This is the amount. Instead of 25,000 naira, that is the carrying amount. What they disposed it for is 20,000. So it means they made a loss of 5. So 5,000 naira loss. So 5,000 is the answer. Look at it here. Good. Let's move to question 6. Question 6 says, which of the following about goodwill is true? If you have not watched my video on goodwill, I've taught us that there are 2 types of goodwill. I talked about the purchase goodwill, and we also talked about the inherent goodwill or internally generated goodwill. Please go back and watch that video. It's going to help you. Now, which of the following about goodwill is true? A goodwill is always recognized as an intangible asset in entities' financial statement. This looks correct, but it may not be correct because of this always. You see this? Do we always recognize goodwill? That is not true. There are some goodwill that we don't recognize according to standards. If the goodwill is inherent goodwill, that's internally generated goodwill, we don't recognize it. So let's go to the next option. But this question is not completely wrong. But this always, I'm looking at it somehow. Let's look at B. Goodwill represent the total value of a business asset and liability. That's not true now. C. The value of a business is solely based on the value of its net asset. Is that about goodwill? No. Goodwill reflects a business potential to generate future profits, making it an intangible asset. That is correct. I don't see anything wrong with that. But let's look at the next option, whether it is more correct. E. Successful businesses do not have goodwill as it is not considered a valuable. That's not true. That's fallacious. So we'll come back to option D. This is the correct one. You pick this. You pick this. This is correct. Now look at it. It said goodwill reflects a business potential. If you are acquiring goodwill, or if you are acquiring a business, sorry, if you're acquiring a business, the business is worth 500. You look at the net identified, that's the identifiable net assets of that business. And it is worth 500,000 naira. But you are willing to pay 600,000 naira. Why? Why are you paying that? Are you Father Christmas? Of course not. You are paying 600 even though you know that the net assets are worth 500 because you see a potential to generate future profits. And that makes it an intangible asset. So the question is D. Let's move on. Question 7. How much inventories did the owner of the shop withdraw during the period? If the opening inventory is governed by IAS2. Go back and watch my video on IAS2 inventory. It's going to help you, not just to answer this question, but to help you as an accounting student or for someone who is learning financial literacy. How much inventory did the owner of the shop withdraw during the period? If the opening and closing inventories for sale. So opening is 56,250. How much inventory did the owner of the shop withdraw during the period if the opening and closing inventories for resale were 56,250 and closing was 48,750. So this is closing inventory and this is opening. Now, they want to know the drawings and there were no sales during the period. Usually, what will make your inventory to reduce is because you made sales, isn't it? But in this case, you did not make sales. So, now the difference will simply be this minus. I think this is straightforward. It's just 56,250 less 48,750, and that is let's see. So this is 56,250 minus 48,750, and that's 7,500. So that is our answer. Okay, so let's go to the next one. Let's look at the next one. Question 8 says, which of the following best describes the concept of digitization in accounting? Digitization, you know, digitization, the process, what's the concept of it? The first one says digitization is the process of converting digital files. No, it is not digitization. If they are already digital files, then it is not digitization. Digitization, they are not digital yet. B, digitization refers to the use of digital technologies to create invoices and receipts. That looks legit. Digitization, C says, digitization involves converting physical accounting records, such as invoices and receipts, into a computer readable format using digital technology. This is the correct answer. So it is when the records you have are physical, they are accounting physical records. They are not. Now the process of converting them into invoices and receipts, okay? into computer readable format. That is digitization. So you are entering them into a computer readable format. That makes them so that, and you are using digital technology. D says digitization is a practice of manually. No, you are not manually. Any manually is already wrong. E, accounting digitization is solely focused on minimizing human involvement in finance. No, that's not correct. So let's move. That's not correct. So for multiple choice questions, once you are sure of the answer, you don't need to read the other one. Just move as fast as you can. Question 9. Why is it important to record the substance of transactions rather than their legal form in financial statement? Good. If you have not watched my video on substance over form, you have to go and watch it, where I talked about accounting concepts and principles. It's very important. And if you have not subscribed to the channel, please do. Invite your friends, and let's increase financial literacy in our society. Yes. So first, let me explain substance over form. You have the legal form of an entity. The legal form, not the legal form is what the law says. The law says if you do this, fill these papers, pay the capital, you are the owner. But the economic reality may be different. The economic reality may show who is collecting the risk and the reward. So accountants are more concerned about the economic reality of transactions. It is more important to us than the legal form. So it's like, for example, when you look at finance lease, where the risk and rewards are transferred to the person who is using, the person who has leased that asset. The risk and the reward are with him. Now, the lawyer will be looking at it differently. As far as he is concerned, the person that owns this asset is the owner. But for us as accountants, the transaction has to be seen from the substance. Somebody has the risk. The risk and reward is with the person using that asset. So we have to consider the economic reality, and that is what we record. The economic reality is clearer for us because that is a reality. So that is the one that is more important. Let's see what the options are. Legal principles are often complex. No, that is not why we do it. We don't dodge it because legal principles are complex. That is not why. It is because of the economic reality. B, financial statements must comply with tax regulations, not legal principles. No, that is not why we do it. The legal form of transaction does not accurately represent their financial impact. This is correct. So when you use the legal form of transactions, it will not accurately represent their financial impact. That's the economic reality. It will not. That is why it is important to record the substance of transactions rather than their legal form. That is the correct answer. D, let's see whether there's another one that is more correct. Recording transaction based on their legal form is easier. No. Accounting prefer to use financial substance. No, we don't just prefer. I mean, we do it because of the financial impact, because of the economic reality. Let's look at question 10. Question 10 says, which of the following correctly explains the links between the statement of financial position and the statement of profit or loss? If you have not watched my video where I talked about IFRS 18 and IAS 1, I urge you to go and look at that. Look at that video. Also, we have looked at videos where I talked about interpreting financial statements like a professional. Now, it says the statement of profit or loss shows the financial position. Statement of profit or loss does not show financial position. It is the statement of financial position that shows financial position. So that option is already wrong. I don't want to read further to confuse myself. And I urge you to approach questions like that too. B says the statement of financial position affects the statement of profit or loss by adding to the, no, that's not true. C says the statement of profit or loss affects the statement of financial position. Yes, by either adding to or reducing the owner's capital. That is perfectly correct. But let's check whether there's another option that is more correct. The statement of profit or loss affects the statement of financial position. Yes, by adding to and reducing the owner's capital. This is exactly the same with what we read before. He says the statement of financial position affects the statement of profit or loss by reducing the. You see, this one is talking about reducing. This one is talking about adding. This one is saying by either adding to or reducing. So this is correct. As I told us before, for multiple choice questions, the difference might just be one word. It's just one word that will make the whole lot of difference. So this is it. The statement of profit or loss affects the statement of financial position by either adding to. It adds to if it's retained profit, and it reduces the owner's capital if it is a loss. So that is the correct answer. Let's move to 11. 11 says, which of the following correctly describes the accruals concept in accounting? If you have not watched my video on accrual concept, please, I urge you to go and watch it. Expenses. A says expenses are recognized in the statement of profit or loss in the same period.